and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Thanks for having me again, Push. Always a pleasure.
We truly appreciate your time and insights as we explore critical topics shaping the landscape of corporate cash and treasury management. In today's edition, Paul, we shall discuss 4 topics, namely the DNA of tomorrow's corporate treasury, 4 countries global companies should enter, expand, or invest in, China's foreign trade makes strong start to 2024, and finally, business insolvencies already above pre-pandemic levels in most advanced economies. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with the first story, which is about building a treasury that is fit for the future. In other words, the DNA of tomorrow's corporate treasury lies in corporate treasurers and their teams embracing certain crucial skill sets. Today, the role of Treasury is expanded vastly, with the C-suite relying more and more on the function as a respected voice on a wide range of strategic issues, from climate risk and social issues to managing working capital and financial forecasting, according to the Association for Finance Professionals and Zander's white paper titled The Future of Corporate Treasury Teams. With Treasury becoming an indispensable component in various organizational functions, spanning from playing a key role in M&A transactions to guiding decisions related to supply chain dynamics and commodity risks, it's crucial to build a forward-thinking Treasury that, as per AFP's white paper, is resourced and structured to adapt to a rapidly changing market and rising demands for transparency and elevated financial performance. Paul, to enable optimum performance and build a future-ready treasury, what critical skills do you think corporate treasurers and their teams must embrace?
Well, Push, this article does a really good job of pointing out the skill sets that are really needed by treasury departments today. These are real skills. They are in demand. There are treasury units that are working on developing these skills. There are treasury units that need to do it. There are some that have already taken those steps and put them in place. You're finding demands on treasury departments to be much more significant than what they used to be. It's no longer just an accounting job. It's an actual department within an organization. And it has ties to all areas within the company. And so now it's become more critical that treasury or treasurers have a seat at the table in talking about strategic value or direction within the organization, because they do have a say in a very positive way. Back in the day, I used to do mergers and acquisitions for an insurance company, and we didn't really utilize Treasury very much. Occasionally we did. We'd bring them in, but nowhere near the level that you see today. And so that was, almost 20 years ago. Today, in the environment, you need Treasury at the table in all aspects of your business. So I'm just going to kind of step through these skill sets that this paper, the article points out about the AFP paper, the technical skills. This is becoming so critical within Treasury. So it points out an analytical mindset. There is no doubt that analysis today in Treasury is super important. It used to be, all you had to worry about was, we make cash payments today, we receive cash today, we ensure that we have enough cash in the accounts to cover everything that needs to happen. And that's what they would do. But today you need to have a better understanding of how cash is actually moving. When is it needed? Where is it needed? How much? How long do we have before we need to have the cash available? What do we do with that cash in the meantime? You got to have forecasts. You need to have some kind of projection of what those demands will be. You need to be talking to business units to develop products and services. You need to be talking to your corporate M&A team, for instance, in terms of they may need cash for a deal, or there may be cash coming in from a deal. What do you do with that cash? How do you deploy that? How do you finance and fund all this? Capital management is super important. So having that analytical mindset where you can start thinking about these critical issues within a corporation, I think are really important. The other thing is being detail oriented. You certainly don't want to have a mistake made where you record something opposite, as this article points out, opposite direction of what it should be. That's not a good thing. That throws everything out of whack. And obviously human error can happen. The use of technology today can help with that. It doesn't mean that being detail oriented becomes less. It becomes actually more in today's environment because there are so many aspects that Treasury is involved in. So having that detail oriented capability is super important. I touched on technology. Technology continues to develop at a very rapid pace. We've moved from host-to-host platforms within a company to SaaS-based, PaaS-based, cloud-based technology, distributed ledger technology, DLT is becoming a bigger aspect, or the use of blockchain, artificial intelligence, machine learning, APIs. These are all technologies that are being utilized today in various capacities, some more than others. But the reality is that treasurers and treasury teams need to stay up to date on these technologies because they are utilizing them or are going to be utilizing them. And the reality is you need to be utilizing them. They're good technologies to help treasury units. Providing an insight. This is really a newer critical aspect of being a treasurer or being part of a treasury department. Now that they have a seat at the table with the senior management team, the senior leaders in the company to provide strategic direction, having insight as to what's going on within the corporation will help them make decisions. So insight is super important. The next area that the article touches on is the business skills. This is definitely important. I think it goes hand in hand with the skills that we talked about before, but being able to understand the business that you're in and being able to be very concise in the way that you deliver information and present it, I think is really important to the leadership teams. So having those business skills become more and more important for treasurers. The outward skills. I had one of my bosses told me one day, he's like, Paul, I think you need to have a little bit different mindset in how you deliver or communicate to people. He said the soft skills matter. And, I was in a role within this particular company that I felt like I needed to tell them what they needed to hear. Well, yeah, I did need to tell them what they needed to hear, but the way I delivered it wasn't received well. So developing those soft skills, these interpersonal skills, the human skills, as they point out in this article, that is really important. You have to be able to connect to the audience that you're trying to deliver a message to. And you got to deliver it in a way that you get buy-in. So these soft skills are really important. And if it's something you need to develop, you can listen to webinars, you can listen to podcasts, you can read books, and that can be helpful. I suggest that anybody that's wanting to develop these skills further is you find a mentor and you find that kind of person that has that capability. Some people just naturally have it. Some people are able to develop it over time. And I believe this is something you can develop over time. It is really important. It is. And when I think about Treasury as it continues to move forward, I think what we're going to see is that they're going to be bringing not only the strategic value, but they're going to be bringing the business acumen to the table that's going to help their senior leadership team make better decisions. And ultimately, that's what any corporation wants. They want to be able to make better decisions.
Thank you for highlighting the key skills that corporate treasurers and their teams ought to embrace to build a treasury that is fit for the future. I think the fact that you mentioned that you need to find a mentor, I think that's, in my mind, one of the most important things that treasurers need to do to be able to build a treasury that is forward looking. And you're absolutely right, and I couldn't agree more. Let's now shift our discussion to the second topic, which is about India, Indonesia, Vietnam, and Poland, four countries that global companies should enter, expand, or invest in. India is on track to become the world's third largest economy by 2027. Indonesia is projected to become the world's sixth largest economy by 2027. Vietnam is positioned to see the sharpest increase in wealth growth in the world over the next decade, and the UK's Labour Party leader, Sir Keir Starmer's warning that Poland is on course to overtake the British economy by the end of this decade, not to mention that Poland lies at the center of Europe on the main trade route or transport corridor linking Europe with Asia, are compelling cues that indicate the need for increased attention and focus on these nations from global companies and their CEOs, CFOs, and treasurers. Paul, I wrote this article, Four Countries Global Companies Should Enter, Expand, or Invest in, that has been published on ctmfile.com. If I were to request you to disregard my opinion, would you, as a treasurer or CFO of a multinational corporation, actively seek out and capitalize on business opportunities that these four countries offer? And if so, why?
I think we've seen in recent years that corporations, whether US based or Europe based, are rethinking how they do business in the sense that should we have such a concentration of manufacturing distribution with one country or not? And obviously China has been, a dominant player for US manufacturing for some time now. And I think when we had the pandemic hit and we've had some strain between countries, companies have been rethinking how things are done. I'll talk about that, but I'm going to talk about another aspect that's been a disruption to distribution as well. We definitely had disruption to distribution. It's also had companies step back and rethink how distribution works. And with that, you've seen more concentration or focus on maybe an allocation of partners that you utilize. It doesn't mean you completely eliminate China. It means that you rethink who you're going to partner with. Maybe it becomes a lot more strategic, and you think about risks associated with those partners that you utilize. And so it's been friendshoring, it's been nearshoring, there's been some onshoring as well. We've seen that happen. And China's been feeling some of the pain of that for sure. So they've done a couple things that, one thing in particular that I think has helped them somewhat between themselves and Russia, they got an agreement with oil distribution that, they're picking up oil distribution. Russia is buying stuff from China as well. There's a relationship that's going on there, and I think that's probably helped both those countries in terms of not feeling more pain than perhaps what they're feeling. Of course, with China, the truth is not totally revealed to the rest of the world of what's going on, but they've definitely been feeling pain. You can't have, a big downturn in your property sector and there not be a lot of pain going on in the economy. So we know there's pain going on there. And with that, companies thinking that they need to diversify. You're seeing that these other Asian countries, and Poland in particular, as this article points out, for particular manufacturing, people are going to these countries. There are alternatives. And I think we'll continue to see growth, as this article points out, in those four countries in the article for sure. The question will be for India and China, who have historically not had great relationships, what kind of strain will that put on the relationship between India and China? It feels like as India rises and China has some lower aspirations in terms of future growth, there might be some tension between those two countries. We'll see what plays out there. China's control of other countries that have key manufacturing where they feel like they can flex their muscle, I think we'll probably see more of that as well. With Poland and manufacturing of lithium batteries for electric vehicles, I think that bodes really well for them. I think we'll continue to see growth in Poland. The one thing I do want to point out is with the turmoil in the Middle East, we've obviously seen a lot of disruption in supply chain. Yeah, the canal, Suez Canal through there, there's been a lot of disruption in that area, and it's created some problems for companies that are trying to get goods for manufacturing or developing or creating their products. So it's definitely created some issues. So as we continue to have political unrest or strains and these war skirmishes that we're having, skirmishes is probably not the right term. They're wars, right? I mean, they are. They're causing problems, but as we continue to have these, I think we'll see opportunity for countries like India, Indonesia, Vietnam, and Poland, or others to have growth in their manufacturing arena as organizations look for other opportunities to get the goods that they need to continue to manufacture the products that they have. So stability is going to be a key thing in terms of where this actually ends up going. So yeah, it'll be interesting to see what happens over the next several years.
Stability will be the key. Paul, your ability to bring a unique perspective about these four countries is commendable. Thank you for adding a refreshing dimension to the conversation. Moving forward to the third topic in today's discussion, which is about China's foreign trade making a strong start this year. China's foreign trade grew faster than expected in January and February of this year, helped by electronics and increased exports to emerging markets in Russia, with Beijing's foreign minister touting a new paradigm in relations with Moscow. Exports rose by 7.1% in the first 2 months of 2024 from a year earlier, well above the estimate from a Reuters poll of analysts that forecast an increase of 1.9%. Imports were up 3.5%, also beating the estimate of 1.5%. China reports economic data for January and February together to account for the disruption of the annual New Year holiday. Paul, from an international corporate treasury perspective, do you believe that the trade rebound in China will help shore up confidence in the economy?
Well, it certainly doesn't. It doesn't hurt. I think peeling the onion a little bit more would be where we could have a better view or aspect as to how real this is. This article points out that the increased exports were to emerging markets in Russia. I think Russia plays a significant factor, the relationship that they have with them. And if that relationship didn't exist, what does it really look like? It's probably something much less. So, this is definitely something that's good for China from their aspect. Do I think that these exports or the growth in the exports is going to continue to grow at that pace? I don't think so. The Chinese don't even believe that. They're targeting 5% for GDP for this year. That maybe that's a realistic number. That's certainly not at the number of the growth of exports we've seen the first 2 months of this year. So they must anticipate that things are going to level off. Otherwise, they wouldn't have stated 5% as their target. Now, 7% several years ago, that would be kind of normal growth number you would expect to hear out of China. So I think the Chinese are feeling some pain right now. There could be some additional pain ahead of them. It feels like China has some levers that they can pull. At least the Chinese feel that they are in position to do that. And I think they probably are. They are certainly an economy that is in transition at this point. So we'll have to see what happens in terms of not just the manufacturing, but we talked about earlier, the property sector, because there's definitely some issues there. So is it a slowdown or a standstill in the property sector? I think that remains to be seen. I think they had gone to a standstill in many instances. I think there's probably some pain for the class in China that's have been on their way up in terms of prosperity. And so I think there might just be a little bit of a stumble for them along the way, but we'll see how it pans out. Which, if they continue to have pain, I think you'll see, some of the things I talked about in the prior article, perhaps more confrontation with the US, more confrontation with India, and more muscle flexing in terms of Taiwan or potentially other areas that the Chinese may feel is their property, for lack of a better term. So we'll see. We'll see. I think there's just more to come with China. I don't think it's going to be a great year for them.
You don't think it's going to be a great year for China? Watch this space, listen to this podcast, and hopefully by the end of the year, we'll have an answer. We'll know if Paul was correct or his prediction turned out otherwise. Next up, let's delve into the fourth story, which is about business insolvencies already above pre-pandemic levels in most advanced economies. After two gradual rebounds in 2022, global insolvencies are set to accelerate again in 2024 before stabilizing in 2025 at high levels, according to the latest global insolvency report from Alliance Trade. As expected, 2023 recorded a high-speed and broad-based rebound in business insolvencies, and 2024 started with insolvencies above pre-pandemic levels in most advanced economies. The number of business insolvencies rebounded in 3 out of 4 countries in 2023, with most recording a double-digit increase. We saw sharp rises in the US and in the Eurozone, with the Netherlands, France, and Germany on the front lines. Alliance Trade does not expect a tsunami of business insolvencies as recorded in the aftermath of the great financial crisis, when global insolvencies skyrocketed by 17% and 19% in 2008 and 2009 respectively. However, the catch-up should be noticeable in several countries, in particular the advanced economies of Europe, due to specific firms and specific sectors. Paul, 2024 is expected to be a year of reality checks for firms and economies. If that's true, what do you think will be the key reality checks for corporations in 2024 and beyond?
Yeah, Push, I think this is just natural evolution in the global economic environment. You can't have high inflation, you can't have high interest rates without there being some pain along the way. Yeah, that's designed on purpose, right? That's why central banks take those measures that they take from a monetary standpoint, where they're looking at interest rates, making decisions on moving them up or down, depending on what's going on from an economic standpoint. And we've had extended high rates and high inflation at the same time. Here in the US, over in Europe, these are places that have experienced that. Some of the places in this article have been somewhat more insulated in terms of feeling those effects. But the reality is that from a China perspective, a slowdown in the US and Europe doesn't bode well for them. Anyway, I say slowdown in the sense that these policies that the central banks are taking really start to take hold, which we haven't seen evidence that it's fully taken its grip yet. And it usually takes time. So you raise rates, it's not instantaneous that everything slows down. It takes time. We're starting to see some mild indications that it's starting to work, although CPI that just came out yesterday in the US was a full percent higher than what they anticipated. Inflation is just still rearing its ugly head. Payrolls were also fairly robust. So we're still at or near full employment here in the US from an economic standpoint. So the pain hasn't fully come through. As we see this really start to take grip, I definitely see more insolvencies happening, this in Europe and the US both. So I think this article, really does a good job of pointing out what we've seen so far and kind of giving some indication of what we expect to see this year and in the future. So I think over the next couple years, this kind of projection that is shown here makes sense to me. So the question is what's the ripple effect for these other countries? It has an impact on India, China, South Africa, I'm not so sure about, but what kind of impact does it have on these other countries? I think it will have an impact. And so, from an overall global standpoint, things should slow down based on what central banks have done to slow things down in economies that have high appetite for goods and services. So it's just a natural aspect of the way economies work. So I think next several years, we are going to see an uptick in insolvency. So the 5 aspects that were pointed out in this article, the profitability squeeze, it's already here. I don't think it's looming. I think it's already here. I think that's going to continue to be a bigger pain. So while we haven't necessarily seen it in headline earnings, I think we're definitely going to see it. That may be the aspect that they're pointing out in the article, that in terms of what the headline earnings are saying, we're going to see the pain there. And I think that's true. Uncertainty in the rise from geopolitical or rising non-payment risks, that is definitely there. So you and I have talked about this before. When I think about U.S. consumers, they did quite a bit of buying at the end of 2023. That is buy now, pay later. And that's credit. That's credit extension, in addition to what they might have on their credit cards. So I think there's definitely some repayment risk that's out there. I always think about financing and liquidity conditions being tight. Yeah, it's going to remain. The only way that's going to loosen up is the bank reserves become better and interest rates drop. And then I think you'll see that, financing and liquidity will start opening up. Until we see those interest rates drop, it's just going to be tight, and the banks are going to, be a lot more conservative in their extension of credit and lending practices. New business will face their first real resilience test. I think 2024 is the test year. So we're going to find out, what businesses are going to be able to weather the storm, because we're basically, in the eye of the hurricane. And when are we going to come out of that? Well, second half of this year for U.S., I anticipate that we'll start seeing indications economically that will incent the Fed to drop interest rates, but it's going to be second half of this year. Some sectors pose higher risk to jobs and to wider economy. This is definitely true. So this article points out like 2 areas that, are key. One, discretionary spending, consumers. What are they going to spend their extra income on? Goods, services. Areas that touches manufacturing, retail, non-essential goods, hotels, restaurants, tourism, leisure activities, all this stuff. It's discretionary spending. That's going to become a lot tighter, I think, throughout this year. And then labor-intensive markets, where you got construction, road transportation, hotels, restaurants, those kinds of things. I think you're going to definitely see a little bit of a squeeze on that throughout this year. There's been a lot of robust activity coming out of the pandemic. I think people were anxious and ready to spend because they've been cooped up for so long, and it's extended for a period of time, and it just hasn't cooled off enough. So I think, this article does a great job of pointing out these aspects and touching on the things that could have an impact on businesses throughout this year and next year.
You raised some interesting points, Paul, and I agree with you when you say that 2024 will be the year of tests. Finally, Paul, what is your choice for the biggest or most important story of the past week, and why?
For the last week, it's the inflation numbers. Economists were expecting 3% number. It came in at 4.1%. It's still too high. And so that is a big deal. The Fed doesn't have enough to make a rate decision on today because inflation isn't where it needs to be. Jobs are still fairly robust. Until we start seeing some self-inflicted pain, I think that we're going to continue to have high rates. We're not going to see the Fed make a move. So until pain happens, unfortunately, you hate to see it, but this is a natural evolution of economics. You got to have the pain before you can have the relief. So I think we've got a little bit more pain ahead of us in the second half of this year. I expect that we will see some Fed movement the second half. It could be towards the late third quarter, fourth quarter before we see it potentially. I don't know. We'll have to see where economic indicators come in over the next several months.
Well, as we wrap up this podcast episode, I'd like to extend a heartfelt thank you to Paul for sharing his thought-provoking perspectives. Your insights have truly enriched today's discussion, Paul. We would also like to express our deep gratitude to our CTM Foil audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.